Hey everyone, welcome to another deep dive. I'm thrilled to jump into today's topic.
Yeah, thanks for having me. I'm really looking forward to digging into this one. We've got a really comprehensive guide on trading accounts to unpack today.
We do.
Yeah.
And our mission today is basically to help you figure out how to choose the right account by seeing past all the shiny marketing claims. Because
Mm.
reading through this source material, it makes one thing glaringly obvious.
Right.
Choosing a trading account is exactly like buying a car. I mean, you wouldn't buy a Ferrari with a massive V12 engine if your daily routine is just, commuting in stop-and-go city traffic.
Exactly.
You have to know your driving style first.
Right.
But people constantly buy the Ferrari when they really just need a Honda Civic.
Yeah, they do. They get totally blinded by the flashy marketing specs. But, trading styles have completely distinct mechanical needs.
Mhm.
Like a brand new trader, they shouldn't be worried about top speed at all. They need training wheels. That means finding an account that allows for micro lots.
Right. Okay, let's define that real quick for anyone who isn't trading daily. A micro lot is essentially a tiny fraction of a standard currency trade, right?
Yeah, precisely. It's trading 1,000 units of currency instead of the standard 100,000. So it lets beginners risk literal pennies instead of hundreds of dollars per trade.
Wow. Okay, so it's super low stakes.
Right, because the goal for a beginner isn't massive returns yet. It's building discipline with small, controlled risks.
That makes sense. But if you shift gears to, say, a scalper,
Oh,
someone who is jumping in and out of the market dozens of times a day to grab tiny profits, those micro lots just don't matter. They need raw execution speed and structural freedom.
yeah, they have a totally different set of needs. They have to make sure the broker even allows high-frequency trading in the first place, or executing trades during really wild major news events.
Because some brokers will literally just freeze them out of the market.
Oh, absolutely. They will freeze you out. And then you contrast that with swing traders who might hold positions for days or even weeks.
Right.
They don't care about the tiny fraction of a cent it costs to enter the trade. They have to watch overnight swap fees.
Okay, swap fees, that's when you hold a leveraged position past the daily market close strike.
Yeah,
You usually have to pay an interest charge to keep that trade open overnight.
exactly. That's the swap fee.
So if a swing trader is bleeding money on interest, while a scalper is bleeding money on execution speed, I mean, traders are basically working with completely different bottom lines depending on the broker's specific fee structure.
Totally.
But wait, okay, let's unpack this a bit. I'm constantly seeing brokers advertise zero spread accounts.
Oh, yeah, the classic zero spread.
Right, like that sounds like a no-brainer.
Yeah.
Where is the catch with that? Isn't that automatically the best deal?
Well, what's fascinating here is that zero spread is usually an illusion.
Wait, really? An illusion?
Yeah, I mean, the spread is just the difference between the buy and sell price of an asset, right? But if a broker offers zero spread, they certainly aren't working for free.
Well, yeah, they have to make money somehow.
Right. So what they do is they charge a separate fixed commission per lot traded. You aren't paying a markup on the asset's price, but you are paying a flat fee right at the door.
Oh, I see. You're just paying for it in a different aisle of the store.
Precisely. You have to look at the full round-trip cost. That's the total cost to open and close the position.
Okay.
And you must check that cost on the actual instrument you trade. Like, a broker will advertise an incredibly flashy low rate on the EUR/USD currency pair just to get you to sign up.
Right, as bait.
Yeah.
Yeah.
But if your strategy revolves around trading gold, ex-EUR/USD, that EUR/USD marketing rate is completely irrelevant. You need the specific round-trip cost for gold.
So if traders think they have a free account but are actually getting hit with fixed commissions, they're working with way tighter margins than they realize,
Huge problem. Yeah.
which naturally makes how they use leverage even more dangerous.
I kind of like to think of leverage like a power tool.
Oh, that's a good way to look at it. Yeah, like a nail gun. It helps you frame a house way faster than a manual hammer. But if you don't know how to use the safety stops, your stop losses and acceptable risk, you're going to put a nail right through your hand.
Yeah, that's incredibly accurate. Because leverage provides margin flexibility. It allows you to put down a small deposit to control a much larger position, which keeps more of your actual cash free.
All right.
But a massive mistake traders make is letting the maximum available leverage dictate their position size.
So they just max it out because they can.
Exactly. But your position size should only be based on strict, predefined risk parameters.
And understanding those parameters means knowing the broker's invisible tripwires. The guide heavily stresses checking the margin call and stop-out policies before you deposit a single dime.
Yeah, those are critical. A margin call is essentially a warning light on your dashboard. It tells you that your free margin, which is the usable cash in your account that isn't tied up in active trades, is running dangerously low.
Okay. And the stop out.
The stop out, however, is the automatic forced closure of your positions.
Oh, wow.
Yeah, if your total account equity drops to a certain percentage, the broker's system will automatically liquidate your trades to prevent you from going into a negative balance. And every single broker sets those percentages differently.
That is terrifying if you aren't paying attention. But, knowing those mechanics is one thing. You still need the right workshop to actually use these power tools. The guide gets really into platform ecosystems, and it's super clear these aren't just cosmetic skins for looking at charts.
No, not at all. The platform dictates what you can physically execute.
Right.
Like if your strategy relies on complex algorithmic trading and custom-built robots, expert advisors, you are essentially forced to use MT4.
Because that's where the coding infrastructure has lived for decades,
Yeah,
right?
exactly. Now, MT5 was built to offer a wider scope of financial instruments like stocks and futures alongside much deeper analytical tools. But if you need modern order management, like if you want to scale in and out of trades in fractions of a second, you're going to naturally gravitate toward a platform like CTrader.
And some of these ecosystems offer even more layers, right? Like Monaxa, for example. The source mentions they integrate live accounts, copy trading, and PAM accounts.
Yeah, Panda Amkets are basically a system where you can pool your money with a master trader who manages it for a fee.
Right. But going back to the costs, there's an incredibly practical and honestly often overlooked detail here. You have to match the account's base currency to your own bank account's currency.
Yes, it seems minor, but if you don't match it, you are bleeding money in constant conversion fees every single time you deposit or withdraw funds.
Just constant little cuts.
Yeah, those tiny operational frictions will just drag a perfectly good strategy down.
Well, to avoid that, the guide offers a brilliant 4-question checklist to hammer out before you start.
Yeah, this is great.
It's, what are your main instruments? What is your tip? If demo accounts lack those true emotional stakes, at what point does staying on a demo account too long actually start building bad trading habits?